And you know, you don't have to look far for layoff news that we're hearing about. Just yesterday, a company that we often look at as a Canadian growth story, Shopify, cut jobs for the second time in a year in a move that will make its workforce about 20% smaller. Let's put this all in context. Craig Basinger is Chief Market Strategist at Purpose Investments. Nice to see you. Happy Friday, Craig. You have a strong jobs report out of Canada today, which, you know, in the past, we would say this is great. The economy is humming along. It's just that we have this tricky moment in the cycle. What's your assessment of these numbers and what it tells us?
Yeah, I mean, you know, the labor markets have been pretty resilient, I would say, for the last year or so. I mean, there's no question about that. And, you know, there's also no question that if you look at most of the coincidental data, the data that's showing you the economy today, hop on an airplane, try and book a restaurant.
Yeah, we're going to talk about Air Canada a little
later. Try and book a restaurant on a Tuesday. It's a lot easier on Mondays and Fridays, but Tuesdays, Wednesdays, Thursdays, it's a lot harder to get a seat. Listen, the economy's still chugging along, but the fact is, like, if you look further down the road, and I don't know how far down the road that is, you know, there's more and more evidence showing up that things are slowing down. But yeah, 100%. These were good job reports. Canada, I mean, Canada's monthly data flies all over the place. The U.S. is a little bit more resilient. And I would point out the U.S., even though, you know, last month's there was a big downward revision for U.S. employment, and so this positive surprise might be taken with a bit of a grain of salt. It was impressive. There were a lot of gains in higher paying jobs, and that's been one of the issues because we've been seeing good paying jobs, such as Shopify or Google or, you know, other areas, you know, diminishing. And a lot of the job gains have come in lower paying jobs, which obviously isn't the greatest mix. So it is a bit encouraging. We've had some better paying job additions of late.
And we mentioned a lot of part-time positions in this latest Canadian figure. So for people who are trying to figure out where the economy is headed, we had that soundbite from yesterday's speech from Tiff Macklins, the head of the Bank of Canada, who is projecting that we will see a cooling of the economy. We will see a slowdown in the jobs market and a cool down in inflation as well, which is obviously something that they have been hoping for because of all these higher interest rates. So given this is a monthly figure that you have to take with a grain of salt, given that it's looking to April as opposed to where we are going from here, do you think what do you think the likely scenario for the Bank of Canada is from here?
Yeah, I mean, I think the Bank of Canada is clearly on pause. I don't think they're going anywhere on that front. I think, you know, from what we've been seeing, and again, we focus more on the U.S. data and the U.S. economy just because it drives markets a fair bit more. But yeah, listen, inflation's getting better. There's no denying that. There is also no denying that a lot of the economic data continues to weaken. If you look at sort of the Citigroup Economic Surprise Index, which measures sort of how the preponderance of the data is coming out relative to expectations, it's trending lower. It's trending lower in Europe. It's trending lower in the U.S. It's trending lower in Canada. And it might get a bit of an uptick from these employment reports. But looking at all of the data, you know, the trend is certainly on the softer side.
So what is your investment strategy in the face of all of that macro stuff?
Yeah, like, you know what, I think when we were on a little while ago, we talked about how we, you know, trimmed a little bit of our international equity. This is in our multi-asset portfolios and, you know, moved into bonds and cash. Just last week, earlier this week, we also trimmed Canadian equity as well. So we're now like probably, I would call it a moderate underweight in equities. And we put that in lieu of cash. And the reason is we just feel more comfortable being defensive. And even in the strategies that we employ, like at the direct equity side, you know, we have a pretty strong defensive tilt in our North American dividend fund, which has us, you know, overweighting healthcare, telcos, and more of the defensive areas.
So defensive areas because you think the economy is, despite the resiliency so far, going to take a leg lower?
Yeah, I mean, like, I think the risks for the economy are to the downside, but then I also, you know, we don't buy economies. We don't buy and sell economies. We buy and sell stocks, and the fact is, like, a lot of the companies are actually not sitting at expensive valuations, but certainly not at a discount. And I think in an environment where, you know, you can get 4 to 5% with cash, you can get 4 to 5% in the bond market, quality bond market with a fair bit of duration in case there is a recession. Like, those are pretty appealing valuations on that side of the portfolio. And while equities aren't expensive, you know, you have to acknowledge, like, are they primed to, you know, have stronger than expected returns or average returns or lower? And we just think right now the probability is probably to the lower side, and that's why we're tilting a bit
playing
more
a little more defense.
Yeah.
Craig, thanks for